Why mutual fund investors who are HNIs and ultra HNIs are moving and migrating from mutual fund to AIFs, alternative investment funds, more particularly in CAT 2 and CAT 3. Let me explain that why. Now, there were high net worth individuals who used to invest in mutual funds, fixed income product very heavily. But with the change in the taxation now, because there was a time when mutual fund fixed income products used to give indexation benefit to the investors, and therefore their effective yield used to be much higher, to the tune of about gross yield to the tune of about 8% and net yield to the tune of 6.5-7%. But now that has gone away, so they will have to pay long term and short term capital gain in the fixed income mutual fund. So generally this is like more than 1 crore, 2 crores, 3 crores kind of, because they are fixed income. So it is the money chase performance. So they are looking out to replace that money with better performing funds. And that is how AIF category 2, more particularly performing credit, or you can call it private credit funds, are shaping up big time in India. There, you will not believe that the size of this industry in no time has grown beyond 1 lakh crores. And we've seen these investors are rushing and investing in these funds, because here the indicative yield is about anywhere between 13% to 16%. Now, when you hear these numbers, obviously it is double than your mutual fund fixed income returns. But one of the reasons why are they migrating is that they've now seen that these private credit funds have a track record to believe. There was a time when these funds were launched, there was no track record. But first of all, these AIFs are now launched by reputed fund houses, which has 10, 15, 20 years of long track record of running mutual fund fixed income products. Now they are the manufacturer and they are the one who is also launching private credit funds. So their investors are moving from fixed income product to private credit or a performing credit fund, where the gross yield is about 15%, and plus on top of that you get regular payout, which is to the tune of 1% monthly in your bank account. Now investors are very happy, let me tell you. And this category, which is now 1 lakh crore, in next 5 years time there are possibilities that this number will cross more than 3.5 to 4 lakh crores. This is what I believe is going to be done. That's number one. The number two, private equity funds. Now there are investors who have been investing in equities through mutual funds since 2002. Now they have almost 22 years of track record to be seen in their portfolio. So they've already seen multiple cycles, multiple crises like Lehman Brothers crisis, or maybe 2020 COVID crisis. So they are confident. Now they want to come and invest in money in companies which are not listed. So either they buy directly or they do it through fund manager. They prefer to do it through fund manager because fund managers are capable enough to identify the trend first, that which industry is going faster. For example, semiconductor industry is going faster. So they are identifying companies there and investing their money. And they're coming at the early stage of those companies and trying to ride through the growth journey of that company. So that's the second point, that these investors have seen a lot of interest in the particularly pre-IPO funds. And the size of this pre-IPO fund in no time has become almost 95,000 crores to 1 lakh crores. Because when India produced more than 50 unicorns, none of us have made money. So this is the time Indian investors are taking a lot of interest. The other thing, category 3 particularly. Now category 3 is as good as mutual funds. The only difference is in mutual fund you have daily NAV pressure from the regulator. But here you declare, in AIF you declare monthly NAV. That's number one difference. So fund managers are not under pressure to perform day on day basis. When you don't have a pressure of performing on day-to-day basis, then these fund managers tend to take slightly longer call, in the sense that they identify some small businesses which may be small now but maybe have a potential to become large. Maybe they are a small company but they are in the verge of becoming mid caps, or maybe there's some mid caps which are in the verge of becoming large caps. So they identify them at an early stage of their growth curve in AIFs and create a concentrated portfolio. In mutual fund, generally you have 50, 60, 70 companies. Here, generally we've seen you don't have more than 20 companies. So these are high conviction ideas. And when you have a concentrated portfolio, and when you can take the pressure of volatility, because it can go through difficult time because it's a concentrated portfolio. But if you have patience and ready to go through that roller coaster ride, then AIF is meant for you. Here the minimum ticket size is although 1 crore, but it makes a lot of sense, and we've seen the studies suggest our data that most of the AIFs we have seen, CAT 3 particularly, have outperformed mutual funds significantly. So if you are someone who is investing in mutual funds and your portfolio size is more than 3 crores, 4 crores, 5 crores, then I think it's a time for you to revisit and diversify your portfolio and explore these new two investment vehicles that I am referring to, which is AIF and PMS. Hi, my name is Vikas Agrawal and I am the founder of Altport. Alt is your alternate and Port is your portfolio management services. And we are emerging as one of the largest platforms for investing in alternative investment funds and portfolio management services. So either you can book a call by visiting our website, which is altportfunds.com, or you can click on the link which is given below and our team will reach out to you and share these data points. Namaste. Thank you.